Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is February 24th of 2022. We're certainly glad you could join us this week because it's an important update. We've had a lot of history unfold on the geopolitical standpoint. Really the first time since World War II that one country has invaded another one in Europe. Of course, we're talking about the Russian invasion of Ukraine that has elicited a lot of trepidation and fear amongst investors, including our own investors, right? So we want to take this moment to really ease some of those fears because at the end of the day, right now, we're invested in companies that have zero impact that have zero exposure as it relates to their revenues and free cash flows from the economies of the Ukraine and Russia. And largely what we've seen, even in Europe, is that largely life has gone on. Yes, it's a tragedy what's taking place in the Ukraine, and people's lives are going to be lost, and we definitely pray for those people. But as it relates to the stock market, as it relates to the businesses that we are invested in, we simply do not see any fundamental impact as it relates to sales or the overall fundamental development of these business models going forward. So I think that's a really, really important point. But as it relates to this week's update, what we're going to do is go through at the end of the day the fundamental question that we all have as investors when we go through a painful stock market correction, which is, do we want to simply buy, sell, or hold during these moments of trepidation and fear? Secondly, we definitely want to review the state of the current stock market sell-off and answer that important question, or at least take a stab at answering that important question of how long will it take to recover from current losses? Because a lot of times the fears that we hear from clients and from outside pundits and on TV or on the radio is that, oh my God, it may take years to recover. So we want to dispel some of those myths as well and really project where we see that recovery going forth and how long it will take to recover some of those losses. Now, when we're going through a painful stock market correction, we have three fundamental choices. We can buy the same stocks we already own. We can buy some different stocks. We can sell what we have, or we can hold. We can do nothing. And that's an important question because when we think of the biggest mistakes that were made in 2008, 2016, 2018, 2020, it wasn't what we owned, right? It wasn't owning stocks going into the correction. It was what we actually did during the correction. And to this day, when we come across new clients and we look at their biggest pain points, it was not that they owned stocks going into the correction. It was that they panicked and they sold and then sat in cash after the correction was over. In other words, they crystallized the losses, then they saw the stock market recover and said, well, I'll just wait for the market to pull back again. And unfortunately, the market doesn't pull back for another 2 years. And then they're completely thrown off kilter. So we want to put a process around how we should assess the decision of buy, sell, or hold. And then, of course, what we want to do is go through the statistics and the numbers as to what has led to some of the more beneficial experiences in the market going through corrections. So what has been those experiences? So what we simply did is, as portfolio managers, we wanted to ask ourselves, when we're going through a correction, going through corrections going all the way back to 1980, right? So that's about 30 different corrections or so. What were the decisions that led to the best 1 year forward returns and beyond? So option one was to sell everything. Now, the average loss when we go through corrections going all the way back to 1980 has been about a 16.5% decline for the overall stock market, right? So just under that 20% mark. So if we sold everything, we're crystallizing that loss at 16.5%. We're going from $100 to $83.50, and we're staying there. So we've protected that $83.50, right? Because when people sell during corrections, what they're really saying is, I want to protect what I have left. Okay, so that's important. You got that $83.50 left. Now, for the investors that decide, you know what, I get it, the market's down, but I'm just not going to do anything. What have been their experiences, right? In many cases, the market continues to go down. It can go down another 10%. And you're like, oh my God, maybe I should have sold 10% ago. And the people who sold at that 16.5% mark are saying, I'm really smart and I feel really great that I did. But let's fast forward out to 1 year. What we see is the person that did nothing has experienced a 25.9% return over 1 year just in the S&P 500 from after experiencing that 16.5% loss. In other words, they're back over $100 and they're wealthier from when they started investing versus option one that actively sold the market, stayed in cash. They're now poorer by $16.5, sitting at $83.50. So the person that did nothing on average becomes wealthier versus the person that panics and sells. I think that's an important point because why do we invest? We invest to increase our wealth. So we always want to look at the option that will most likely, from a historical standpoint, time and time again, lead to us becoming more wealthy. Now, what about geopolitics? We took geopolitics going all the way back to Germany invading France, right? And what we see here is an important distinction. Geopolitics, quite simply, don't matter. But they only matter when there's a recession 1 year out. So in other words, what does this mean? When there's no recession and a sharp geopolitical event takes place, the 1 year forward return is 10.8%. When there is a recession, that return is minus 11.5%. So what's the key variable here? A recession. And guess what? All these recessions, more often than not, with the exception of that global financial crisis there, they're not the result of the geopolitical event itself. In other words, not the result of war or political intrigue or anything like that, right? What causes a recession is quite simply the regular business cycle or the credit cycle as it relates to the banks. So right now, credit's healthy, demand is strong in the US. That's why we're seeing inflation and supply chain hiccups. So we're in this category according to our work. There's no recession complemented by a sharp geopolitical risk event that's taking place and taking stock prices temporarily down. So we look at 1 year forward returns from a stock market correction, right around that 20, what was it? I think we said that 24% markers or 25.9%. And then we complement that with a geopolitical pullback with no recession. That average return's been about 10.8%. So again, what is based on that data, do you want to buy, sell, or hold? Based on that data, we look at it and say, we either want to be buyers or holders, but certainly not sellers at these levels. And that's the same question we ask a lot of people as it relates to real estate. If you owned a house from 2008 through 2011, did you want to go ahead and sell that house or buy more real estate? And 10 times out of 10, people say, well, I wouldn't want to sell the house. Why would I do that? Market prices were at a bottom. Housing was likely to go up from there. I would probably buy another house if I could afford it. Same thing with stock prices. When stock prices come down, if the businesses are in good shape, they're reporting good earnings, and the valuations are attractive, why would you sell? Hold it, unless, of course, you need the money. And that's a conversation between a client and their financial advisor as it relates to their goals and when they need the money and when they can let the money sit and be invested for the long term. So the other question we have, of course, is how long will it take to recover losses? And the easiest way to look at this, ladies and gentlemen, is to really understand how far your stocks have come down after a 52-week high. Quite simply, it's like a tennis ball. The higher we are, if I'm sitting on a chair and I drop a tennis ball, it might bounce by like a foot. But if I go up to the roof of our building and drop that tennis ball, physics quite simply determines that that ball is going to bounce a lot higher because the drop was higher, right? And so stocks are quite simply the same way. So what's going to recover faster off its lows? Growth stocks or value stocks? We think as a growth strategy, since growth has been at the center of this correction and has pulled back a lot more than value stocks, that growth will outperform value over the next couple of weeks and months going forward. In fact, we think that the time to recovery in terms of the current losses will be measured in months and certainly not years, according to our models and work that we do in the background here at the home office. And then, of course, why is investor sentiment so important? Why do we pay attention to it? Quite simply, ladies and gentlemen, is that once investor sentiment gets so bearish, you quite simply run out of sellers. If you think about it, if you own 10 shares of Apple, how many shares of Apple can you sell with the exception of short sellers? 10 shares. Once you sold that 10 shares, you're out of inventory. Well, so the similar thing happens across the entire stock market. You simply run out of shares to sell. And once that happens, that willing buyer of last resort that comes in has a disproportionate impact on the stock price to move it up. So when we get to bearish sentiment of this level, we see here on the chart, historically low levels of bullish sentiment, everyone's bearish, that's when you want to step in and to start to buy stocks. And we see that here on the volatility market, right? So we said is, okay, when volatility is high, in other words, people are paying up for portfolio insurance, they get paid when stock prices come down in the form of put options. What has been the forward return when volatility is above 30? And what we see here is we look at the distribution of stock market returns. The red line is when the VIX is above 30. And we can see there's a disproportionate level, is what we call fat tail to the right, of positive returns with the stock market 1 year forward when VIX is above 30 versus when it's down close to 12. This is the time you want to buy stocks, when VIX is above 30. And then, of course, the invasion itself. It sounds, doesn't really sound great saying it, but you want to buy the invasion. So whether we're looking at Vietnam War, the first Gulf War, Afghanistan, Iraq, the Crimean crisis, which is laid the template for today's crisis, quite simply, the lead up to the war causes way more trepidation, fear, and stock market losses than the actual invasion itself. Once the invasion takes place, stocks tend to say, hey, guess what? We were fearing impending doom, so we panic sold the market. Oh, guess what? Doom has arrived. The world didn't end. Let's buy stocks. And that's typically how it works. So we wanted to put this map here real quick. This is the current flight map of Europe. You can see here, this is where the war is, the Ukraine. This is Europe. And we put this here for a reason. Life goes on. And even in Europe, people are flying, going on vacation, doing business. Yes, there's this tragedy taking place here, but you know what? Life goes on. So the bottom line message is that stock market corrections can make us feel awful, but overall, we kind of need these things to reset ourselves before stocks can catch their breath and then resume that upward trajectory onto new highs. So the three big takeaways: panic selling generates some of the worst long-term rates of return. Patience, resilience, and tactical buying during moments of weakness causes some of the best long-term rates of return. Number two, the Russia headlines are certainly scary, but really mean nothing for most US businesses outside of really like McDonald's, Coke, or Philip Morris, which we don't own any of those. And then, of course, present-day volatility is often an asset for future return. So thank you, everyone. We know it's been a volatile week. We know there's a lot of uncertainty as it relates to the war over in Eastern Europe. But the good news is we really have no exposure to that war, and our businesses are hitting the ball out of the park as it relates to the fundamentals and the cash flows. And if you have any questions or concerns, please feel free to reach out to your advisor. And otherwise, have a fantastic, safe, and fun long weekend.